how do you entrust your life, your home, your family's future to a single piece of paper? The answer, if you don't know the one-sentence difference between a business and a company, then you already are. Because these two words create a monumental power difference in the eyes of the law, one that can either protect you or turn your entire assets into a high-stakes gamble. This video is not just a lesson, it's a wake-up call. Anyone who misses this, where we unravel the real difference between a business and a company, the secrets of company types, and which one acts as a shield or a sword for you, will forever regret not watching it right now. Hello. When I started this channel, I made a promise to myself. I will not waste your time with anything unnecessary. Here, I will not distract your thoughts with flashy effects or background music, because I believe the fundamentals of starting a business, company finance, budgeting, and personal wealth are so vital that the only thing you need is pure, distilled, applicable knowledge. My job is not to turn information into a show, it is to place it in front of you in its core form, in the most understandable way. That's why, today, and in all videos from now on, our focus will be solely on knowledge itself. Simple text, clear diagrams, and the essence of the topic. That is our magic. What about you? Are you also in favor of this style of presentation? Or are you thinking, this is too simple? I want more visuals and dynamism. Please tell me in the comments, because this channel is for you, and we will chart our course together. Now, without further delay, let's begin our first lesson. First concept: business. A business is the place where an idea meets economic value. It doesn't matter whether it's a shoe shiner or a huge factory. A business is a tool you use to make a profit. And the best part is, you can use this tool even on your own. However, here, your business as a tool changes when it evolves to the next level, a company. So why? Answer: for synergy. More capital, more brain power, and most importantly, to share the risk. A company is a shield that the law provides to your business, a legal entity. The golden rule here: every company is a business, but not every business is a company. So how does this shield work? Everything is hidden in liability. A wrong choice means personal bankruptcy. The right choice means safe growth. Unlimited liability companies. This is a sword. What does it mean? The company's debt is your personal debt. The term unlimited means that your liability is not limited to the company's cash. Joint and several means that the creditor can demand the entire debt from you alone. Concrete example: suppose you set up a sole proprietorship with two partners. The company owes a supplier $100,000 and is on the verge of bankruptcy. The company's cash register only has $20,000. The supplier has the right to claim the remaining $80,000 entirely from you. To pay this, you might have to use your personal savings, sell your car, or even your house. Only after you pay this $80,000 can you try to recover the $40,000 share from the other partner. Limited liability companies. This is a shield. What does it mean? The company is a separate, artificial person from you. The company's debts are the company's debts. Your liability is limited to the capital you have committed to the company. Concrete example: suppose you set up a limited liability company and invested $50,000 in it. The company unexpectedly goes into debt of $500,000. Creditors can only seize the company's assets: office equipment, bank accounts, company car. Your personal house, car, and family savings are completely safe. Your maximum loss is limited to the $50,000 you invested. Creditors cannot touch your personal assets. In short, every hand you play with a sword, sole proprietorship, risks your entire wealth. A shield, capital company, on the other hand, is a strategic game where the maximum loss is predefined and safe. Now that we have learned the basic logic of companies, let's examine the most common types of companies under two main categories: sole proprietorships and capital companies. Sole proprietorships, power and reputation, belong to the individual. In these companies, power and reputation come not from the company's capital, but from the partners themselves. This is a sword. General partnership. All partners have unlimited liability. Definition: all partners have unlimited and joint liability for the company's debts. What does it mean? Partners are responsible not only with the capital they invested in the company, but with their entire personal assets. Concrete example: 3 partners set up a general partnership. The company suffers a loss of $200,000. The creditor can claim the full amount from any one of the 3 partners. That partner might have to sell their personal house to pay off the debt. Limited partnership, a hybrid structure. Combining sword and shield. Definition: this company includes 2 different types of partners. Managing partner, sword side, runs the company, has unlimited liability. All personal assets are at risk. Capital partner, shield side, only invests capital, does not interfere in management. Liability is limited to the capital invested in the company. Concrete example: a managing partner and a capital partner establish a limited partnership. The capital partner invests $50,000 in the company. When the company fails, the managing partner's entire personal assets are at risk. The capital partner only loses the $50,000 investment. Capital companies, power and reputation. Lion Capital. In these companies, power and reputation come not from who the partners are, but from the size of the company's capital. This is a shield. Limited liability company. The entrepreneur's shield. Definition: partners' liability is limited to the capital they have committed. Concrete example: an entrepreneur establishes a limited liability company and invests $25,000 in it. The company faces a compensation claim of $300,000. The entrepreneur's maximum loss is $25,000. Personal assets are fully protected. Important note: they cannot operate in high-risk sectors such as banking. Joint stock company. The giants of the big game. Definition: liability is still limited to the capital, but they can issue shares and go public. Concrete example: a technology company goes public on the stock exchange, raising millions of US dollars from thousands of investors. If the company fails, no investor loses more than the amount they paid for their shares. Public talk private. Companies whose shares are traded on the stock exchange are public, while those whose shares are not traded are private joint stock companies. Bonus: informal partnership. The most casual form. No written agreement or registration is required. Example: 2 friends verbally agree to work together on a project and share the profits. This is an informal partnership. Conclusion: as you can see, every business idea and appetite for risk has its counterpart. Are you going to start a small, trust-based business, or a giant that will expand to the world? In the next video, we will cover the basic principles of money and markets, which form the lifeblood of your business and investments. If this content added value to you, don't forget to subscribe to the channel and turn on the notification bell. Our goal here is to grow together and become stronger through knowledge. For now, take care and see you next time.